Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the WealthyHomeowner.ca, Canada's authority on home ownership. Welcome back to the show, Ross.
And thanks for having me back, Jim.
Ross, we're now moving into our second lockdown in parts of Canada. A listener was wondering, will this lead to higher house prices again?
Higher house prices. So, the last time it was inevitable you would see higher house prices. Because in the last lockdown, the lockdown happened right after first-time buyers had finished their buying spree. Meaning that all of the sales that were, the trade-up sales that were going to take place after March, which inevitably raised the average selling price, were already in the queue. And that's why in April, you had an average selling price of $188,000 nationally. Then when the lockdown ended and people were out buying houses again in a rush in June, July, and August, it was almost all trade-up buyers. Those trade-up buyers facilitated another trade in September, October, November, and in sometimes even a fourth trade. So the most expensive houses that are selling would have been selling in those months. What's different with this lockdown is those trade-up sales are no longer in the queue. Because if there were trade-up sales in the queue, the selling price, the average selling price that has been reported since August, September, October, wouldn't be as high as it was. The only reason it reached that price was because the number of first-time buyers active in the market had dropped right off. Well, the second consequence of first-time buyers not being in the market is that the market stalls. Sales will begin to be recorded as declining. You already saw this when you saw the Real Estate Board's release, or the Canadian Real Estate Association release, when they claimed month-over-month sales had dropped 0.7%. Okay? So this is a natural way how a housing market works. This time, the second lockdown, the first time you're going to see that the market is reemerging would be a decreasing average selling price, which we call the average purchase price, because that would mean first-time buyers have reawakened and re-entered the market. We do not expect that to be taking place. You're going to know this number somewhere around 6 weeks out from now. So when the Canadian Real Estate Association releases next January, their year-end for 2020, they're going to remain silent. All they're going to focus on is the house price illusion that they created during the calendar year 2020. After January the 15th, everything that they reported during the entire year will be forgotten. They'll never cite it again. They'll always be comparing the gain that took place in 2020. First-time buyers have not been active in the market to save the market going forward.
We'll have more with Ross Kay right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Ross Kay. Ross, we keep hearing reports of people moving out of cities into smaller towns with the plans of working from a bigger home. You've discussed this before on the show, but we're wondering if your opinion on that has changed over the last couple of months.
My opinion hasn't changed in terms of the fear of missing out that organized real estate has created through a simple little tiny jump in the number of sales that are taking place in higher priced homes in cities outside of the major CMAs. So in other words, a wealthy buyer, meaning someone who's going to spend $800,000, this is a wealthy buyer in the terms of a city like Cambridge or Kitchener or London, jumps into those housing markets. Okay, when they jump into those housing markets, the sales that were normally required to make that home sell don't happen. There's no need for it. This is the same thing that happened in Vancouver. Were the foreign buyers. Foreign buyers bought a house that was over $1.5 million. But when the foreign buyer moves into the market, you don't have the sale of the $400,000 house, the $600,000 house, the $800,000 house, the $1.2 million house, finally resulting in the purchase of a $1.5 million house. Because all those sales together create the average selling price. When the average is only looking at that most expensive home selling, wow, that's a huge jump in average selling price month over month, year over year. Organized real estate never tells you that. Okay? So that part of the message, what we're saying to you, hasn't changed. Yeah, there'll be a few more buyers in late trading cycle behavior, following common late trading cycle behavior, that move from the major cities where houses are more expensive into the smaller towns where houses are less expensive. That said, lock down our data, our own personal data, our own business data of people in our buyers programs, okay? This is a unique data set because it gives us an insight into home buyers in a way that never is before possible in this short of a period of time. Because over the last 6 months, we have seen about 40% of the home buyers in our buyers program shift to what they're looking for in a house. Normally that shift takes place around 15%, Jim. In other words, once they get educated in how our system works, the strategy that they should employ, about 15% of the people will alter the goal of the home that they set out to acquire when they join the program. Over the last 6 months, we have seen it at times, it hit 43%. But I will say beyond a reasonable doubt, it's 40%. Like it's 40% now, that people have changed the home that they're going to acquire. And the reason that that's happened, Jim, is people have had time to think. This lockdown is a single opportunity that even real estate agents couldn't hold back. Because you have to understand, a real estate agent and the real estate MLS system is built on a structure to get you to act immediately on the immediate terms you're looking to buy a house on. In other words, someone calls you up and tells you, hey, I want to buy a house for $400,000 in a bond, for $900,000 in bond. You immediately set up appointments, go and show them a house, and you sell it to them. You don't give them time to think about whether or not that's the right decision. Because if you don't take them out and sell them that house, someone else, another real estate agent, another real estate broker, will take them out and do it for you, and you'll lose the commission. So the entire industry is designed to get the buyer client to act as quickly as possible buying the most expensive house that you can sell them. That's just how it works. Now, under this circumstance, the buyers have been forced to have time. Real estate agents weren't able to stop it. Real estate agents, there was nothing that they could do to rush you out. Now, they've tried with virtual tours. They've tried with Zoom calls. They've tried with virtual walkthroughs. But they still can't get people, first-time buyers specifically, to act the way that they normally act. So, as we're sitting here today, people have had about 6 months to reevaluate things. And if you were in a position where you were considering the market in the fall of 2019 into the spring of 2020, and you hadn't already sold your existing home, In other words, you were still planning, timing the market. You were still looking at what you were going to do. You've had an opportunity to look at yourself over these last 6 to 8 months and reevaluate where you want to be a year from now, 5 years from now, 10 years from now. And this is the very first time where people have been allowed the time to do that. And we have a unique data set because of our buying program members. We have a unique data set because they're interacting with us on a regular basis. We're seeing in real time how their buying preferences are changing, how their target homes that they're looking to acquire are changing. And these are not changes that organized real estate wants to make. Because the result of these changes, Jim, is that people will trade homes at a slower pace. Real estate is designed to try to get you to move every 7 years. So you get a commission every 7 years from your clients. By people following a logical, rational procedure, taking their time, they reduce the number of trades that they make because they stay in their houses usually between 10 and 12 years. Some people, if they really take their time and they make their planning right, they'll stay there 15 years as they're moving up the property ladder still. These delays are wealth builders. Each delay that you make in a home trade, as effective as of 2020, is going to give you about has the potential through strategy to put an extra $150,000 in your retirement bank account when you're 65. This is not what organized real estate wants. They're going to do everything in their power to stop it. This is not what the banks want. They're going to do everything in their power to get you to go back to those old buying habits, where the very first thing you do is walk into a bank, get pre-qualified for a mortgage. You don't walk into a bank. You should never walk into the bank and say, we'd like to get pre-qualified for a mortgage. You should be going to the bank and saying, hey, we're looking to get a mortgage of $350,000. Will you give it to us? Two totally different outcomes in your life are going to result.
We'll have more with Ross Kay right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, a listener asked about mortgage interest rates and was wondering if you believe they have bottomed or are further changes expected to happen.
The changes I think that we're going to see going ahead, Jim, will be historic. That said, the interest rates that you're able to get right now, lock in at right now, are just a once-in-a-lifetime opportunity. Listeners who are asking the question, you shouldn't be gambling. You have an opportunity to take a 5-year rate at below 1.5% in many cases right now. Do I think that rates could go lower? Well, it's possible. But if rates go lower, they go lower for a reason. That's because the economy is tanked. Moody's just recently updated Canada's rating at a AAA rating, is what they rated us at, okay? Moody's, one of the major rating industries, the reason they rate us as that, because what the Canadian Real Estate Association has sold as being the truth between April and November of 2020. That the average selling price went from $488,000 in April to $607,000 in October. They sold this book, this story, and the rating agencies believe them. Because the rating agencies believe Korea, CMHC believes Korea, bank economists believe Korea. They all believe them, okay? That's allowed Canada to maintain its mortgage, its rating, AAA rating, in spite of announcing they have somewhere around $350 billion of debt this year. A deficit of over 350, but we're maintaining our AAA credit rating. Why have we maintained it? Well, we've maintained it because the rating agencies actually look at house prices. That the rating agencies actually only care about the housing market. And when the housing market, the fraud that is committed in the Canadian public between April and today, and in the following 6 weeks, it gets exposed for what it is. The rating agencies are going to lower our credit rating. That means the mortgage interest rates are going to go up. So you've seen this opportunity, and you really need to look at it, folks. You need to be looking at your mortgage to equity ratio, not loan to value ratio, like the way that the banks tell you, which is a percentage. You need to be looking at your mortgage to equity ratio. Now think about it. You have a $100,000 mortgage. You have $10,000 in equity. You have 10 times the amount of mortgage debt than you do equity. Okay? This is a totally different consideration to a 10% down purchase, which is 90%, because you're looking at it from a buyer beneficial viewpoint. Oh, I'm going to have 10 times more mortgage debt than I do equity. And then look at the flip side, folks. What happens when it goes 50-50? Well, your mortgage to equity ratio is 1. Your mortgage to equity ratio is 1. And every equity dollar you build after that point, the ratio will be a decimal. So we started out at a 10, and now we're into decimals. It's a totally different mindset that results when you look at mortgage debt this way. Loan to value ratio is a seller beneficial metric created by organized real estate and the banks to convince you that it's okay to take on mortgage debt. Mortgage to equity ratio not only fully informs you about the risk that you're taking on, but it also transforms how you look at it. Because you're not just looking at how much mortgage you pay down each month, you're looking at how much equity you're growing. Equity is dependent on house prices and mortgage debt pay down, both at the same time. So that chart moves far more radically than the loan to value ratio does. Even though they shouldn't, they do, because the way that they're calculated. So I would tell your listeners this: if I've got an opportunity to take a 1.5% mortgage for 5 years, or I have an opportunity to take a 2.7% mortgage for 10 years and lock in that rate, no matter what happens in the world, no matter what happens as a fallout of the $350 billion deficit Canada is booking right now, my family is protected as long as I can make that mortgage payment. And if I'm sure I can make that mortgage payment, that's the decision that I'm probably going to make. You need to sit back and make these decisions rationally and from a financial perspective. You shouldn't make them emotionally, and you shouldn't make them based on the opinion of a mortgage broker, a mortgage advisor at a bank, or a real estate agent, because those stakeholders in the real estate industry are only interested in getting you to pay the most amount of interest that they can get you to pay. You know that because they talk loan to value ratio. We don't talk loan to value ratio. We talk mortgage to equity ratio. And that's the number as a buyer that you need to focus on. So when you're talking about these mortgage rates, will they go lower? They might go a little bit lower. Would I gamble on them? Not in a million years. It would only be in special situations where I was not worried about my employment or about my money, I would be gambling against these mortgage rates. And I think that's the starting point that this listener should be looking at. How much are you willing to gamble after a pandemic lockdown of your nation that is going to leave the nation at a minimum $350? We believe when it's all done, Jim, we're going to be in excess of $600 billion in deficit between April and April, when the lockdown first happened to when calendar year after that period of time. You have to sit back and decide what amount of risk you're going to take, what is the most rational outcome that's going to happen, because we can tell you over the last 40 years of real estate data, what you think rationally is going to happen almost always happens. What everyone else is telling you is not going to happen is almost always untrue. Home buyers, homeowners, Canadian families are far smarter than any bank economist, any real estate broker, any mortgage broker in this country. Canadian families know in their heart what risk is and what it would cost them, and they should be making the decision based on a rational assessment of the risk that they know in their hearts is ongoing right now.
Ross, thank you so much for the update.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.